Hello friends, welcome to the MOOCs on Entrepreneurship Development. In this session, we will discuss regarding the facilities and incentives from the national level agencies. There are four videos in this specific session, and this is the very first video. In the Indian context, the micro, small and medium enterprises are categorized based on the investments. The categorization is varying from country to country, but in our country it is based on the investments. The investments in plant and machinery, that is for the manufacturing enterprises, and it is on the equipments for the enterprises which are providing or rendering services. Now, as per the MSME Development Act 2006, for the manufacturing sector, a micro enterprise is an enterprise where the investment in plant and machinery does not exceed rupees 25 lakhs. So, investment up to rupees 25 lakhs in plant and machinery alone in the case of manufacturing sector is known as a micro enterprise. Next is a small enterprise, which is an enterprise where the investment in plant and machinery is more than rupees 25 lakhs, but does not exceed rupees 5 crores. Then a medium enterprise is an enterprise where the investment in plant and machinery is more than rupees 5 crores, but does not exceed rupees 10 crores. So, these are the limits for the micro, small and medium, and if it is more than 10 crores, this is a large scale enterprise. This is only for the manufacturing sector. In the case of a servicing sector, a micro enterprise is an enterprise where the investment in equipment does not exceed rupees 10 lakhs. Here the investment is in the equipments, there it was in the plant and machinery, and here the limit is rupees 10 lakhs, there it was rupees 25 lakhs. For the small scale, the limit is from rupees 10 lakhs to rupees 2 crores. In the case of a medium sector, the limit is from rupees 2 crore to rupees 5 crores. So, this is for the servicing sector, the investment in the equipment. The loans not exceeding rupees 20 lakhs granted to the retail trade are part of the small service enterprises under the MSME Act. Now, let us discuss some of the salient features of the MSME Development Act 2006. The word industry has been replaced by the enterprise, which includes the service enterprises also. We used to say small scale industries initially, medium scale industries, but now we talk of the small scale enterprises, medium scale enterprises, large scale enterprises, because we are covering the service sector also in addition to the manufacturing sector. The ambit of the sector has been enlarged to cover the medium enterprises, because initially it was only the small scale. Now we talk of the SMEs or the MSMEs, micro, small and medium also. There is a constitution of the MSME board under this act, and there is a simplification of the registration procedures. Let us talk of the importance of the MSME sector. The contribution of the MSME sector to the manufacturing output, employment and exports of the country is quite significant. The MSME sector employs about 42 million persons in over 13 million enterprises throughout the country, and there are more than 6,000 products ranging from the traditional items to the high-tech items which are being manufactured by the Indian micro, small and medium enterprises. Now, this is the graphical description of the contribution of the MSMEs, including the performance. So, we can see on this graphic there are around 13 million MSMEs which are producing more than 6,000 products. 45% of the industrial production is being done by the MSME sector, 40% of the export from the country is from the MSME sector, and 42 million people are employed in the MSME sector. So, this sector is very important, and our purpose of promoting entrepreneurship is that let the students they should turn towards the MSME sector. They can start with the micro, they can graduate to small and then medium sector basically. Now, this is the classification of the MSMEs by location. As we can see on the graph, around 55% of the MSMEs they are located in the urban areas, and around 45% they are in the rural areas. If you see the classification of the MSMEs by the sector, we can see again the graph on your screen. The majority, which is 67%, is in manufacturing sector, 17% is in the service sector, and the remaining 16% is for the repair and maintenance sector. Now, let me touch upon some of the basic definitions, so that before we proceed further, let us have a little clarity. Now, when we talk of the loan, there are two types of loan. One is the term loan, and second is the working capital loan. Because when you go to a bank or when you go to State Financial Corporation to take a loan, so we have two types of loan. term loan and working capital loan. Now the question is, what is a term loan? The loan which you take for the creation of fixed assets is known as a term loan. The fixed assets could be like plant and machinery, land, building, etc. So the loan which you take for that is known as the term loan, and normally we go to the state financial corporations for taking the term loan. The second is the working capital loan. You see, once you create all the fixed assets, you need the money to run the enterprise. You have to purchase the raw material and other necessary utilities. So you need the money for that. So the money which is required for that purpose, that is known as the working capital, and for that we take a loan. In fact, we have got a cycle known as the working capital cycle or the operating cycle. You can see this cycle on your screen. So we have the cash. From the cash we purchase stocks, that means the raw material, and from there it is a supplier payment, because when the supplier supplies you the stocks or the raw material, so there is a credit period of, let us say, 30 days or 60 days. Then with the raw material we have the work in progress, and then we have the finished goods, and then you sell. But when you sell on credit, and then from the credit it is again the debtors basically. So you sell for a credit of say 90 days, and after 90 days you again get back the cash. So there is a gap of around 30 days in case you are getting the raw material for 60 days credit, but you are selling at 90 days credit. So there is a gap of 30 days. So you need the money for regarding that to run this cycle. So that is known as the working capital cycle. This is for the manufacturing, of course. For the service, you see we have the cash. From the cash we sell, and then the debtors. So there is a gap in between, and we need the money to run this cycle, that is known as the working capital, and the loan which we take for that is known as working capital cycle. So normally people go to the banks for taking the working capital loan. Then we talk of the equity, or the PC is promoter's contribution or the margin money. You see, the money which we put in as a promoter, or which an entrepreneur puts in as a promoter, that is known as the promoter's contribution or the equity or the margin money. When you go to a bank or when you go to state financial corporation to take a loan, so they will never give you the 100% loan, they will give you say 75%, 80%, 70%. So the remaining money which you put in, that is known as your money, or the promoter's contribution, or the margin money, or the equity. Then we have the moratorium or the gestation period, because when you take a loan from a bank or from a financial corporation, you cannot start repaying the loan right from the day number 1. You need some time to start repaying the loan. So that time is known as the moratorium period or the gestation period, and this can vary from 6 months to 18 months. Then we talk of the debt equity ratio. Debt is the loan which we take, and equity is your money basically. So for a small scale enterprise, this ratio is normally 3:1. That means if you want to set up a small scale enterprise and you go to a bank to take a loan, so they will give you around 75%. The remaining 1/4, 25% you have to put in, that is known as your money, equity. So and this ratio could be 2:1 for a medium scale or for a large scale enterprise. Then the subsidy is the amount of money which you do not have to return. So the government gives certain subsidies because of certain reasons, like if you go to the northeast, you get the subsidy over there. There are tax holidays, and sometimes the government wants to promote certain areas which are industry backward areas, so they give a subsidy in case you are setting up the business over there. Then the break even point. Now break even point is that point where there is not any profit nor any losses. So the point of no profit no loss is known as the break even point. Now when we talk of the agencies at different levels, there are primarily at 3 levels: the national level, or the federal level, the state level, and then the district level. So we'll take them one by one. First we'll take the national level, and followed by the state level, followed by the district level in the succeeding videos. So I think that is all for this video. You can refer to the online content, the e-content, and the references given over there for further clarifications. Thank you so much.